Hello and welcome to the Booms and Bust Show. My name is Jonathan Davis and a warm welcome to the show where we discuss economics, markets, free markets in particular. Bring back capitalism is the rallying call of the Booms and Bust Show. And the first two podcasts in the modern era, those who used to listen to it last year will know what I mean by the modern era, little private joke, have been received fantastically well. I want to thank you so much for downloading and listening to the show. It's an amazing coincidence, but exactly, and I mean exactly, the same number of people have listened to both shows. So that suggests to me that you listen to one and then you listen to the next one. And I do hope that you're telling your friends about the show, people who you think might be interested to hear about what's happening in the real world, as opposed to the nonsense, fake news, fake economics, fake markets that we get in the mainstream media. Changes. So many things are happening right now. There are big changes happening in economics and markets, and we are going to be looking at that in today's show. Today, by the way, is Monday, the 13th of March. It's about 10:30 in the morning that I'm recording this. So, I'll be reviewing last week, looking forward to this week. Big things happening. I'll tell you what, it's like, Julia Roberts in Pretty Woman. You know that scene where she goes back after having spent obscene amounts of money on Richard Gere's credit card? She goes into that boutique and, she says, "Hey, you work in commission, don't you?" Big mistake. Huge. Well, I'm telling you, this week, big week, huge. And we're going to delve into that very deeply. Very interesting things happening. You know, I'll tell you one thing that is happening this week. You can pretty well bet your grandmother on this, that on Wednesday evening, British time, the US will announce a higher interest rate. I mentioned in last week's show how political the Federal Reserve clearly is. I mean, how disgusting. They raise rates twice in 10 years. In December of 15 and then again in December of 16, not having raised them for since 2000, I think 2006 before that. And they're going to raise them again in 2 days' time, which means from twice in 10 years, it's now twice in 3 months. What's changed? The economy? Ha! You're joking. No, what's changed is that Donald J. Trump has become the President of the United States. And of course, the establishment absolutely despises Trump. Now, I do not want you thinking, because I've referred to this before, that I have this idea that Trump is going to save the planet, that Trump is going to save America economically. I don't think anything of the sort. What I do think is that he is absolutely, utterly fantastic for free speech and anti-PC. PC nonsense, social justice warriors. They can take a run and jump for all I care. I mean, you should look at what is happening to women, homosexuals, Jews, Christians in the Muslim world. And you've got these blooming social justice warriors wearing the black scarves and whatnot. I can't believe how ridiculous, how stupid, how ugly these people are. It is absolutely crazy. Getting back to the point. They're going to raise interest rates for the second time in 3 months. And you will already have read and heard and you're going to hear a lot about it in the next week and weeks to come, that, the US clearly is on a major project of raising interest rates. Incidentally, in December of 2015, when they did raise the rate, for absolutely no reason at all, they did so, and they said that they would raise rates 4 times in 2016. They actually raised rates once in 2016, the month after Trump won the election. So they've now said that they're going to raise rates 4 times in 2017. And indeed, they will start to do so on Wednesday, the 15th of March. And you'll see the press and the mainstream media saying, Janet Yellen, the governor, the chairman of the Federal Reserve, she means it this time. She's going to raise 4 times. 2 points. The idea that in a country which has admitted to debts of $20,000 billion, not counting the non-admitted to debts of somewhere between, depending on who you talk to, 100 and 200 trillion dollars. I mean, the numbers are literally astronomical. The idea that they could raise the interest rate at 5 times in 15 months in those situations is an absolute joke. It is not going to happen. So the strength in the US dollar that we have seen over the last few months, and actually the reality is that it's flat over the last 2 years, the strength that we've seen recently is typical of buy the rumour, sell the news. And this moves on to the second point. What we heard last week are 2 amazing things from both the European Central Bank and the Bank of Japan. Those 2 are 2 of the 4 most important central banks in the world. The other 2 are the Bank of China and the Federal Reserve. The Bank of England. Don't make me laugh. No one cares about the Bank of England. And why should they? Because they're a bunch of numpties who have allowed successive governments to borrow like crazy. And also, they've allowed imports to be a multiple of exports. Thus, the Bank of England, over many, many years, has decimated the pound sterling. And those of you who believe that your cost of living and the costs of running your businesses have risen over the years and decades, you are absolutely correct. And it is entirely down, A, to Bank of England policies, and B, government policies. So, Bank of England doesn't matter. Nobody cares about the Bank of England. The European Central Bank had a major meeting recently, and it came out with its minutes. And Mario Draghi, the head of the European Central Bank, he said some interesting quotes. Monetary policy has been successful. Do you like my impersonations? I mean, hey, you can see I've spent a long time practicing them. Monetary policy has been successful? Are you mad? 20 odd of your 28 countries, Mr. Draghi, are in recession. The only success has been Germany, as far as I can see. So yeah, monetary policy has been successful for Germany, not for the Euroland. And when he talks about monetary policy, he's talking about quantitative easing. He's talking about not just ZIRP, which is zero interest rate policy. He's talking about NIRP. The European Central Bank has a negative interest rate policy. Can you believe it? Negative interest rates right across the Euroland. And that's what they're talking about when they're talking about monetary policy. And no, it hasn't been successful. What it has done, of course, is kept stock markets high and kept the elite in their jobs and kept billionaires as billionaires. On the other hand, you've got the rest of the community, the rest of the population, at best, stagnating, whereas in some countries, they're going down the plug hole. So no, Mr. Draghi, monetary policy has been the biggest corruption since the mafia in the 1920s and beyond. But what he said was, and bearing in mind that monetary policy had decimated, relatively speaking, the euro. So the euro has been falling for years because of their nonsense monetary policy. It has allowed Germany to export more. Of course, it's meant import costs have been more expensive, which of course has protected multinational corporations within the EU. It doesn't help SMEs, the true engines of economic growth in any society, but it helps the elite. But this is what is amazing. Changes. Quote, there is no urgency to do more. Unquote. What he's said categorically, although in the couched terms of a central banker, is they're actually going to rein in what they're doing. Overall, the minutes of the ECB meeting were hawkish. And hawk means you can expect the currency to rise because they're taking away stimulus. The probability of further interest rate cuts have fallen. And indeed, they've actually talked about raising interest rates before they taper, before they reduce quantitative easing. Well, this only came out at the end of last week. And on Friday, the euro soared about 1% against the dollar and against other major currencies. And why would they do this? Why would the ECB be hawkish when it's been bearish, dovish, for years? Well, as you'll see in the attaching tweet to the tweet where I publicise this podcast, you'll see that the Euroland Inflation Surprise Index has gone through the roof because of the very low euro for too long. The Euroland is actually in serious inflation now, serious inflation. And clearly this is something they've got to sort out. So whereas on the one hand you'll see the mainstream media scream that because interest rates are going to rise dramatically this year, by the way, they're not. They will rise, but not dramatically. And therefore the mainstream media says the dollar will soar, which creates heavy deflation. No, the euro will rise against the dollar, which will bring the dollar down, and this will actually bring in inflation into the United States. And if the dollar goes down, we get inflation globally. So that was the ECB. The Bank of Japan, they've basically said the same thing. Japan, according to the Bank of Japan and Bloomberg reporting, Japan is going to begin the tapering of quantitative easing. The Bank of Japan hints it may purchase a fifth less government bonds this year than previously it said it was going to do. And it said this at the end of February. So that means that the yen will actually strengthen as opposed to weaken as it's been doing for ages. The yen strengthening against the dollar. You've got the ECB and the euro rising against the dollar. You've got the yen rising against the dollar. And as it happens, you've probably short-term got the pound also rising against the dollar. Thus, listener, get this. And it's important to your retirement planning and what you're invested in. The dollar is likely to have a severe correction, something of the order of 10 or 15% against global currencies. This is going to be amazing for commodities, for gold miners, uranium, gas. I'll come to oil in a moment. Emerging markets companies and therefore share prices, and indeed also global share prices outside of the US. So put that in your bank account, as it were. You can pretty well stake your grandma on that. Now, this is huge. This is a major change from what has been for such a long time. Indeed, I tweeted today that we bought some more gold mining shares today, Monday the 13th of March. Now, clearly, you don't go into these things willy-nilly without keeping an eye out on what they're doing. And if it's the wrong decision, then we'll change it. But that's what we've done today. I'm just looking down my notes to see what else I want to look at. Yeah, let's carry on talking about markets. Equities, particularly in the US, have come down a little. And yet, if you listen to the mainstream media, if you look at Twitter, it's like the bear market akin to 2008 has started. The S&P was down 0.2%. Don't listen to the mainstream media. I talked last week. I tried to explain to you what government bonds are. And you will have heard and read how government bonds have been falling for several months. And very likely the 35-year bull market in government bonds is ended. Now, listen to the number 2 podcasts from last week for the explanation of government bonds. I'm not going to go over that all again, but I will, just to suffice, I will say, have this in mind. Global interest rates have fallen for 30 to 40 years. Thus, government bond prices have risen. And of course, global interest rates have fallen because we've had lower and lower inflation, and so on. Now, I am looking at a chart right now, which I will also tweet along with this podcast, which shows 30-year interest rates lending to the US government over a 30-year period, stretching back to 1980. So what's that? 37 years. And it shows what we call a resistance. Even though interest rates have been falling, every time they've short-term risen, they've not over 35 years been able to get above the black line that you'll see, which is the resistance line. And that actually is at 3.5%. Now, the 30-year lending rate right now is 3.2%. And until and unless long-term US interest rates can get above and stay above 3.5%, no one on the planet can say convincingly and absolutely that interest rates have bottomed and that we're now in an era of rising interest rates and therefore rising inflation. On the contrary, the long-term trend is still down. The short-term trend since the middle of last year is up. Sure, the 30-year rate bottomed at 2.1%. It's currently 3.2%, which means relatively they've gone up massively. They've gone up 50% in 8 months. It's a huge rise, no question. It's a huge rise. But until and unless it gets above and stays above for a month or two, 3.5%, it's clear on the chart, we cannot yet say that interest rates have actually bottomed. What I would say is that it's 50-50 either way. I said in a previous show that probably later this year, we will know whether or not we're going to go back into recession. And if we do, I can pretty well assure you, interest rates are going to fall. If, however, we see massive money printing and very significant inflation, then sure, we may see interest rates rising sustainably. And then, listener, get this. There is a strong case that if rates go above 3.5%, that's the 30-year lending rate to the US government, go above 3.5% and stay there, we could see interest rates rising for 20 plus years. What's that going to do to the economy? What's that going to do to the housing market? Which is why I said last week, I cannot imagine house prices being any higher in 20 years than today. By the way, the alternative to long-term rising interest rates is that we turn Japanese. And Japan has had very low interest rates for now 27 years. Oh, by the way, their economy's been going nowhere for 27 years. Their unemployment's through the roof. And their stock market fell 80%. Their house prices fell 60% more in Tokyo. So I don't know which way we're going. Are we turning Japanese? By the way, I coined that phrase, hashtag turning Japanese on Twitter, or are we moving to superinflation? I don't know, and I don't really care. You know, these super intelligent macroeconomic guys who say this is going to happen or that, they have no idea what is going to happen. They're sticking their finger in the air and they're making it up and they're assigning probability of this and probability of that. They have no idea of the future. Are they prophets? Are they gods? Of course not. They don't know what's going to happen, but we can reasonably say that currently inflation is rising and inflationary assets are doing very well. Add to that, the euro has likely bottomed, and it looks to me it's going to rise 10 to 20% by the summer. And also the yen is likely to rise. Even the pound is likely to rise, all against the dollar. This is inflationary. This is so important. I just want to make a comment now about the euro. And I can imagine that some of the people listening to this show, and by the way, after just 2 shows, you're already hundreds, which just blows my mind, and I thank you so much. I get your messages on Twitter, and you tell me you get a lot out of the show. It's so fantastic to hear these things. If you want to speak to me on Twitter, criticize as well as comment in a positive way. You know, I truly am for free speech. Of course, if you get ad hominem insulting, I'm just going to block you. So, you know, let's not go there. Let's have a decent debate if we're going to have a debate. On Twitter, I'm Jonathan Davis, where the O is a 0. I heard you shouting that to your phone. I did. You shouted it where the O is a 0. Or email me at jdavis@jonathandaviswm.com. I'd love to hear from you. I'd love to correspond with you. And I will bring these conversations into the show. Some of you who listen to this show believe, because certain political parties, certain commentators say that the euro is the font of all of the Euroland's problems. It's because of the euro that Greece and Portugal and Spain are in such a grave situation. I'm going to disabuse you of that notion if you are one of the listeners who believes that the euro is the reason why certain countries are in abject depression. No, the euro as a currency doesn't do any favours, except to Germany, and it doesn't particularly do harm. What I mean by that is, it's been weak for quite a long time now, as I've just been saying, which has helped German exports and whatever. And it makes, of course, it difficult to import, expensive to import for the countries who need to import. But what I want to say is, I don't believe that a currency is the font of all economic problems. Because if the microeconomics, if the companies within an economy were allowed to get on and just make money without being hampered by socialism, by regulations, by interventions, by so-called competition when it's not, by the multinational companies who are helped by the states, by the countries. If SMEs were allowed to do their thing and make money, I can tell you the currency would be irrelevant. It's socialism and cronyism which are the font of all economic ills, not the currency. You want evidence? I want you to look at the most successful economy on the planet. It's in the heart of Europe. Still confused? It's Switzerland. It's got the strongest currency in the world. And yet, its standard of living is huge. It's absolutely the highest in Europe. And when I think about it, it's the highest in the developed world. Singapore's up there, Hong Kong's up there, but Switzerland is at the peak in prosperity. And so is its currency. Everybody knows you go to Switzerland and buy a pint of beer, you have to take out a bloomin' mortgage. It's £8 a pint. For example, a very trite example, but it is a hugely expensive country. Of course, if you're Swiss, you have very, very big wages, and import costs are dirt cheap. Can you imagine being Swiss and buying imports? Oh, your standard of living is at the moon compared to ours. So get rid of this notion that the currency is the font of all economic ills. It's not. And by the way, it's also not the font of economic solutions. So this idea that you weaken your currency in order to help exports is absolute garbage. Because you weaken your exports, you raise the cost of imports. And manufacturers need to import commodities, inputs into the manufacturing process in order to make stuff to export. So it's total, utter garbage that the mainstream media, the press, the politicians, the BBC, Channel 4, Uncle Tom Cobley, Sky News tell us that a weaker pound is good for the economy. Ha! Absolute, utter nonsense. Just on the point of the stock market, everyone's saying, everyone bearish. Oh my God, I just tweeted yesterday. It's amazing. Bearish comment on Twitter still gets so many likes and retweets. There is so much bearish sentiment, and yet we are at all-time highs. It's utterly ridiculous, and I can tell you, such bearish sentiment is not symptomatic of a bear market. No, the stock market is in a bull market. Incidentally, expect a 10% pullback, which probably started last week. And you will hear absolute rising mania in bearishness and depression. It's the end of the world. 2008, 2000.com, here we come over again. I highly doubt it. It's a 10% correction, give or take, and then we'll get going again in this bull market, which has been going, certainly since January, February of last year, if not, in fact, since 2013. And by the way, a very important markets indicator is the number of items within an index which are at 52-week lows. If the number is high, then yes, the market is depressed and going down. The percentage of S&P 500 stocks at 52% low is 2%. Thus, the S&P, which is the daddy of all stock markets, is not in a bear market or even close to it. We had a big economic stat on Friday, what's called the non-farm payrolls jobs numbers, in other words, new jobs created in the month, and it came out at 235,000 jobs, allowing for a 4.7% unemployment rate in the United States. Just to remind new listeners, I talk about the US stats a lot. Why? Because what happens in the US is far more important to the UK and Western economy than what happens in Britain. Clearly, all other things being equal. By the way, there is a margin of error on non-farm payrolls, so it means actually the jobs numbers could have been between 120,000 and 350,000. 120 would be extremely low relative to recent stats. 350 would be significantly high. Doesn't matter what the number is. It really doesn't. What matters is how the market reacts to the number, to the CPI index, to an announcement by Donald Trump, to a political statement, to a bomb here, to an avalanche there. And it doesn't matter what happens. We're in the business of making money. We're talking economics and markets. What matters is how the market reacts to the news. What happened was the euro shot up, the dollar fell, commodities shot up. This is what's happening, listener. I just want to move on to a little stat I saw about London property. He says, totally changing the subject. I read from the NGO Transparency International that £4.2 billion has been money laundered in London property. Excuse me, is that per month? Because there's no blooming way that's in total. But tell me again why estate agents don't have to show evidence of where the money's coming from. Funny that, isn't it? You want to know why Brexit, why Le Pen, she's not going to win the executive presidency of France, by the way. She will probably win the first round. As indeed, I'm pretty sure her father, should I say, Marine Le Pen, I'm pretty sure, no, sorry, that's her, sorry, is it Francois Le Pen, is that his name? I can't remember. Anyway, her father, I'm pretty sure he also won a first round, but there's no way on earth that France is going to elect the leader of the National Front to be the executive president of France with, by the way, significantly more powers than the US president. No way, Jose. So get it out of your head. But and Trump, you want to know why all these things? The Pew Research Center has produced a report on the household income of high school educated 25 to 32-year-olds through the last few decades. And it's in 2012 dollar terms. In 1979, the household income of 25 to 32-year-old high school educated was $50,000. 1986, $48,000. 1995, $45,000. 2013, $40,000. In real terms, the household income of high school educated adults, young adults, has gone down 20%. You want to know where the income and wealth has gone, listener? It's not just gone to the top 10%, although they've done it very well. It's not just gone to the top 1%, although they've done extremely well. Do you know what? It's gone to the top 1%, who have done obscenely well through George W. Bush and Barack Obama, the two biggest cronyist and Marxists on the planet, who sent all the wealth up to the tiny percent. Do you know what? This is crazy, but it's true. In America, the top 1% now owns as much as the bottom 90%. And you've got the editor of The Spectator today who tweeted that inequality has never been lower. I got news for you, chum. We're not talking about income, we're talking about wealth. But these numpties, these politicians, want us to focus on what we want them to focus on, not the reality. They're all focusing today on wealth, on earnings, and how much the top are paying in taxes. Instead, they should be looking at wealth, because they ain't paying the taxes on their wealth, are they? Who cares? Look, if you're a billionaire and you earn in the UK £1 million a year, do you care about how much tax you pay on your £1 million? No, you care about how much tax you don't pay on your £1 billion. According to S&P Global Ratings, United States subprime car loan companies are losing money at the highest rate since the 2008 financial crisis, as more borrowers fall behind on payments. This is the worst stats since January 2010. So repossessions are rising in the US after crazily easy lending terms and borrowing rates. What could possibly go wrong? And isn't that the same in the UK? How many adverts have we heard or seen? 0% finance. We'll give you £500 to the cost of your acquisition. If you want a car loan, the answer is yes. So think about that. Used cars are flooding the market and are getting higher interest rates, which leads to much higher lease prices. Does that not lead to lower new car sales and therefore prices have to fall? Certainly hope so. You know, this stuff that prices rise because of demand, it's the same with houses. Absolute, utter, arrant nonsense. If you don't lend on an easy basis, you've got no demand. That's the reason why house prices are so high, because we've had crazy easy lending for now 20 years. Literally 1997. Crazy easy lending for 20 years. And cars, it's amazing how many cars are sold or at least registered in the UK, and how many people are driving around in new or nearly new cars. There's no way that their financial position financially provides for it, and yet they do. They're just crazy as far as I'm concerned. It's all very well while you're in work and you're paying whatever it is, say, £300 a month for that spanking brand new car. And the idea clearly is every 3 years you send it back and you get a new one. And they've been doing it for, goodness knows, probably 5 or 10 years. But what happens when we do have a recession and people lose their jobs? You're going to hand it back. You're not going to get a new one. Where are you going to get a car from? People are just crazy. Oh, and by the way, you know those £300 a month, £3,600 a year that you've done for the last several years? So that's what, give or take, say, £20,000. You do realise that you could have put that into a pension and helped your retirement. Oh, and by the way, you'd have got 20 or 40% tax relief. I mean, you do realise this, don't you? Obviously you don't. God, people are just numpties. I will read this out, although it's not directly relevant to what we've just been talking about. In the 23 months from December 14 to October 16, the S&P 500 gained a massive 2.8%. 2.8% in just under 2 years. That, to me, is actually probably what we call consolidation, ready to go for a new massive multi-year bull market. Because you don't have to have bear markets which actually fall. You can have bear markets which do nothing. That, to me, could well be telling us that we're actually in a multi-year bull market. Oh, by the way, in the last 4 months, the S&P's have risen 11%. So 3% in 2 years, 11% in 4 months. There's loads of people out there saying, oh, it's risen too fast, too much, it's going to come down. Well, yeah, I expect it to come down 10%. I do, to practically where it was a few months ago. But that doesn't mean that it's going to carry on. Let's see what happens when we get there. I think it's time to do quote of the week. It's a short one this week by Lord Acton. Socialism is slavery. If you think round the world, listener, where there is socialism, everyone is actually a slave or is a debt slave. Lord Acton, you were a smart cookie. If only more people knew your work. I've pretty well covered everything now that I want to cover. Suffice to say, I think it's been a very wide-ranging show. We've talked about markets, economics, a bit about politics. I think the most important thing is that there's a big change in the markets, and it likely started last week. And with the rise in interest rates this week, on Wednesday, the 15th of March, pretty soon we're going to see the ultimate sell the news. The pound's going to take a the dollar's going to take a lurch down, and this is going to be amazing for emerging market shares, commodities, gold, and other assets. I didn't mention oil, must do so. Yes, oil is having a sizable pullback. A year ago, it was about $26. Until a couple of months ago, it got up to $53, $54. We're currently at $48. You'll hear lots of press comment, the dollar's topped, it's going back down to $20. All I can say is, it can go down to 46-ish, and it's still in a bull market. And with the dollar falling, it probably will do. Oil could well go down to 45, 46, 47. It's already gone down to 48, but it's still in the bull market. So don't listen to the hype. Don't listen to the commentators, the people who write the articles in the press, the pundits, the talking heads on the TV, the shows that have got massive bias and prejudice and agenda. Remember, folks, their agenda is not to make you money. Their agenda is to sell advertising. Their agenda is to suck up to the bosses where there's no advertising involved. Their agenda is to get bums on seats, to get clicks. It's not to help you and teach you what is actually happening. Tweet me, Jonathan Davis, where the O is a 0. Email me, jdavis@jonathandaviswm.com. This is Jonathan Davis signing off from the Booms and Bust Show. Have a great week.